What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We're back at it again to do what? To create something great. Now, today I'm real excited what I have planned for y'all today. We are at episode 3 of our KreativeU series. Now, this series is going to be how we break down different algorithmic trading strategies, how we break down how to read a candlestick, right? Now we're going to be talking about something special, and this is how to pick an option contract for our algos, right? We're going to be talking about at the money, out the money, and the money, and we're also going to be talking about my top 3 Python methods to do this. Now, if you haven't already, I need you to like and subscribe, and make sure you stay through the end, because that third method is going to be the secret sauce method, right? And how our algos really perform well. So let's go ahead and jump on in. What is an option contract, right? So an option contract gives us the right, but not the obligation. It gives us the right in order to buy and sell a stock at a specific price before the specific date. Now, the specific price is going to be our strike price. The specific date is going to be our expiration date. Now, there are 2 types of options. There is a call option. This is the right to buy the asset. And then we have a put option. A put option is the right to sell the asset, right? So an easy memory trick that I use all the time, whenever I buy a call option, I want it to go up, right? Or I'm bullish on the market, right? What do bulls have? Bulls have horns, and those horns point up, right? So if I'm bullish on the market, if I'm buying a call option, if I'm buying a put option, I want it to go down. So I'm bearish on the market, right? What do bear palms? The bear down, right? So you want the market to be able to go down. So an example, SPY, the S&P 500. This is the top 500 companies within the New York Stock Exchange. A SPY 500 call lets you buy SPY at 500, even though it's trading at 520, right? So before we go forward, I want us to really just break down what is an algorithmic option trading strategy, or an algo, right? It is an automated decision-making system for buying and selling options based on the rules that we've designed, right? So what we're doing right now is designing the rules on how to select an option contract, right? So this is part of the process on how to create an algo, right? So let's keep going. So in essence, it's turning your trading plan into clear instructions that the computer can follow 24/7, right? All right, let's keep going. The next thing we're going to talk about is what is a strike price. The strike price is the price written in the option contract. This is the price where we buy a call or we sell a put activates, right? So an easy memory trick is the strike price is the price we're betting around. So for an example, a 500 call, we're betting that SPY will move around 500. A 500 put, we're betting that SPY will move below 500, right? Our expiration date, that specific date, our expiration date, this is the date, this is the last date the option will be valid. After that, it disappears, poof, into the thin air, right? Easy memory trick, the expiration date is the countdown clock, excuse me. So an example, a SPY call 500 that expires today must move today, right? This is a 0 DTE contract. These contracts expire the same day. A SPY call expiring the next month has more time, so it costs more, right? You're paying more theta for it, right? So why do traders care about it? A shorter expiration date is cheaper and it's fast moving, 0 DTE, right? These are contracts that expire the same day. Normally, these are the type of algorithms that we're building here at Creative Coder, right? And then longer expiration, these are more expensive and more stable because they have more time in order to move. All right, next, let's talk about implied volatility. Implied volatility measures how wild the market expects the stock to move in the future. So high IV, we expect a big move. Low IV, we expect calm markets, right? Super calm moves, right? An easy memory trick, right? IV is market vibes, and spicy vibes equal expensive options. That's funny. All right, what it affects. High IV equals higher premium, so options cost more. Lower IV equals cheaper options, so higher IV crushed after news, right, equals an IV crushed. So high IV crushed after news equals IV crushed, right? So an example, before earnings, IV spikes, options are expensive. After earnings, IV drops, options get cheaper even if the price moves your way, right? So let's go ahead and jump over to Claude Code or Cursor. And this is where we're really just going to break this down programmatically on what is an option, right? And I think I'm just going to stay here So lesson one, what is an option? Remember we talked about that. An option is a contract that gives us the right but not the obligation to buy or sell a stock at a specific price. What is that specific price? That specific price is our strike price before a specific date. We have two type of options. We have a call option. This is the right to buy an option because we want the price to go up, so we're bullish on the market. And then we have a put option. This is the right to sell because we want the price to go down and we're bearish on the market, right? We're pulling in the price live from Thinkorswim or Charles Schwab, right? And we're using the S&P 500 or SPY. This is the top 500 companies within the New York Stock Exchange. The current price is 683.04 and the day change is just about 60 cents, right? So here's an example of a call contract. So SPY 683, this gives us the right to buy SPY at 683, even if SPY is trading at 683.04, right? And the premium that it costs is $2, right? And here's a put contract, a SPY 685 put. This gives us the right to sell SPY at 685, even if SPY drops below the price. And the current price is $351, right? Reason being so is because it bought it super out of the money, but we're going to talk about out of the money and the money and how that affects the prices, right? So let's go ahead and go and take our quiz, right? So I need you to follow along with me. Go ahead and put in the comments what you think the answer to the question is, right? So what does a call option gives us the right to do? Is it A, sell a stock at a specific price? Is it B, buy the stock at a specific price? Or is it C, I wish, hold the stock forever and ever, ever, and ever, ever? All right, which one do you think it is? So I'm going to say B. Do you agree? Let's see if we got it right. All right, it was correct. Why? A call is a right to buy the option, right? Think call me up. The price is going up. You want to buy, right? All right, let's go ahead and go to the next question. The next question, you think SPY will drop. What option should we buy? Is it A, a call option? Is it B, a put option? Or is it C? Barbara, I think neither or either will work. Either one works, right? So we think SPY will drop. If it drops, we're bearish on the market. If we're bearish on the market, we want the market to go down, right? Call options is bullish. We want the market to go up. Put options is bearish. We want the market to go down. So let's go ahead and put B. All right, Gucci them. We got it right. So put, we profit when the price goes down. So put it down, a bearish bet. All right. So let's go ahead and continue to the next lesson. I'm going to stay here. I do have everything written down in the whiteboard, but I love the way how it's written out here. So let's stay here. So lesson 2 is going to be our strike price, intrinsic and extrinsic value, right? So what is the strike price? The strike price is the price written in the option contract. This is the price we want the right to buy, a call, or sell, a put activates, right? So a memory trick, a strike price is the target price we're betting around. So the current price for SPY is 683, right? Again, SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. And here is understanding the strike price. So we have in the money, at the money, and then out the money. So we're going to go over this, but right now I want us to be able just to focus on the strike price, right? So 682, this is already profitable for call. 683, this is closer to the, so in the money, closer to the current price, right? At the money is right at the current price, and then out the money, we need it to move up to be in order to be profitable, right? So key insight, a call of 683, you're betting that SPY goes above 683, and a put of 683, we're betting that SPY goes below 683. So what is intrinsic versus extrinsic value, and what's inside your option? So think of the option price like a slice of pizza. So the option price equals the intrinsic value, the real stuff, plus the extrinsic value, the hopes and the dreams, right? So the intrinsic value equals the real money, right? So this is the actual real profit built inside the option right now. If you exercise the option, this is instant and this is what you get. So simple math for calls, intrinsic equals the stock price minus the strike price if positive, otherwise it's going to be 0. So a live example, a in the money call of 682, if SPY is at 683.04 and a strike is at 682, the intrinsic value, this is the real money, right? We have 683.04, this is the current price, minus the strike price 682, and then we have 104. This is real money. This is the option is worth at least, right? So the option price is the real stuff plus the hopes and dreams, the time value and the hopes and dreams plus 21, and we have the option price. So the extrinsic value is the hope money, right? It's the time value. This is what you pay for the possibility for future movement. This is the premium for the time and uncertainty, right? It melts away as the option expires, right? So where intrinsic value comes from, time remaining, more time equals more chance to move equals more value. Volatility, IV, right? Remember we talked about implied volatility. Wilder market equals more potential equals more value. And then hopes and speculation, people paying for the what if. So a live example of the out of the money call with 684 strike. So SPY is currently at 683.04. We getting a strike price of 684, right? So it's a bit out of the money, right? The intrinsic value minus, so the current price minus the strike price, we're negative, right? So it's zero. Wait, it can't be zero. Out of the money options have zero intrinsic value, right? So the option price, the intrinsic value, nothing yet because it's out of the money. It's not close to where the current price is. So this is 100% hope and time. So the big takeaway is in the money options have real value plus some time value. At the money options, small or no intrinsic value, mostly time value. And then OTM out of the money options, this is 100% time value, right? Pure speculation. Right, so as expiration approaches, the intrinsic value, zero theta decay. Only the intrinsic value remains at expiration. All right, so let's go ahead and answer our question. SPY is at 683, and we get a call for 690. Which type of call is it? Is it in the money? Is it out of the money? At the money, excuse me, or out of the money, right? So SPY is at 683. We're betting that it's going up to 690, right? So it's a bit out of the money, right? So it's not in the money. It's not near the option contract. So it's a bit out of the money. So what we're going to say is C. Did we get it right? Gucci. So the strike price is 690. This is above the current price. For calls, the strike price is greater than the price equals out of the money. And then strike price is less than the price equals in the money, right? So let's go to the next question. Next question is SPY is at 683. And then the call is priced at 450. What is the intrinsic value, right? So SPY is at 683, and then the call is at 680. It's priced at 450. So is this in the money or out of the money, right? 680, SPY is at 683, right? So it is a bit out of the money, right? So is the price current? Yep. So it is out of the money. What is the intrinsic value? 450, the whole option price, right? Is it the stock price minus the strike price, or out of the money options have zero intrinsic value? So we're going to go with C. Oh, look at that. Not quite. And I'm glad we got this wrong, right? Because this is one of these questions that stomp everybody. So let's talk about it. Why? Intrinsic value equals the strike price minus the stock price minus the strike price, right? So 683 minus the 680 is $3. Price at 450. So $3 minus the 450 is 150, right? So the $3 is the intrinsic value. The remaining 150 is the extrinsic value, right? This is the hopes and dreams. So does that make sense? All right, beautiful. Let's keep going. All right, and out of the money option is priced at 50 of 0.50. What is the intrinsic versus extrinsic value, right? Out of the money option, right? So it told us the answer up front. Out of the money is completely extrinsic. It is not intrinsic, right? So it's going to be 0 intrinsic, 50 and extrinsic. So we're going to hit C. Gucci them. Why out of the money contracts have 0 intrinsic value? The entire 0.50 is extrinsic, time value plus hope. If it expires out of the money, you lose it all, right? All right, let's keep it rolling. All right, here's a real example. Lesson 3, the expiration date. The expiration date is the last date for the option to be valid. After that, it disappears. It expires worthless if out of the money. Memory trick expiration date is your options countdown clock, right? So here is an available or live look at some expiration dates for SPY. Now SPY has weekly expiration dates, right? We also have, this is 0DTE. So these are option contracts that expire the same day. We also have weekly expiration dates shown here, right? And then we have our monthly expiration dates, and then back to weekly. So shorter expiration, cheaper plus faster moving, 0DTE equals gamblers, right? And then long expiration or expiry, more expensive, more stable. Time is always working against you for option buyers, right? Theta decay. So whenever you hear theta decay, that's time working against us, right? All right, beautiful. Let's keep it moving. So what does 0DTE mean? Is it $0 to enter? That's funny. If it's $0 to enter, everybody will get in. So let's keep going. Is it 0 days to expiration, expires today? Or is it 0 delta exposure? So let's go ahead and put, is it A, is it B, or is it C? Which one do you think? All right, so I think it's B. All right, correct. Why 0DTE is 0 days to expiration? These option contracts, these options expire today. High risk, high reward, fast action. Next question, which option costs more, right? Is it an option contract that expires in 1 week? Is it an option contract that expires in 1 month? Is it an option contract, or do they all cost the same? Now let's think about this. An option contract that expires in 1 week, which one has greater theta decay, right? 1 week, right? So an option contract that expires in 1 week has greater theta decay, where option contract has in 1 month, you have more time for the option to work for your favor, right? And they don't cost the same. So we're going to go with B because we have 1 month. 1 month, we have more time for the option contract to either go bullish if we're buying a call or bearish if we're buying a put, right? I'm noticing a lot of B's for this. Why? More time is more expensive. You're paying for the time value. For 1 month option has more time for the stock to move in our favor. All right, implied volatility. IV measures how well the market expects the stock to move. High IV is it a big swing? Low IV is calm markets. A memory trick, IV is market vibes, right? The spicy vibes equals expensive market. That is super lame. My fault. So the current market vibes, right? The chain IV for SPY is the S&P 500. We have 29%. This is a bit elevated. The market is nervous, right? So IV by the strike price. So we're looking at the different option contracts by the implied volatility. Now, low implied volatility, we expect a 20.90 move in 1 month, right? So super low, very affordable, but these are monthly option contracts. So just keep that in mind. And then the higher we go, the more expensive it is, right? So high IV, these option contracts are expensive, good to sell options. Low IV, these option contracts are cheap, good time to buy options. After earnings, IV crush, option loses value even if you're right? All right, so company XYZ is reporting earnings tomorrow, right? What happens to their IV? IV drops because earnings are predictable. IV spikes because big news is expected, or IV stays the same. So if a company is reporting earnings is letting the overall market know, or the shareholders or whomever is interested, right, how the company did for that particular quarter, right? Did you make money? Did you lose money? How many products did you sell? How many employees do you have? So on and so forth, right? So earnings is very, very comprehensive. So if earnings is coming out tomorrow, this is big news. So if it's big news is happening tomorrow, you're going to have IVs a little bit elevated. So IVs elevated, right? What is going to happen to IV? IV is going to spike because big moves are expected, right? Because earnings is something that the market was waiting for, and now we're getting it. Now IV is going to spike a bit, right? And now we're going to be able to bet whether the option is going to go up and down. So let's go ahead and put B. Again, I'm noticing a lot of B's, bruh. All right, why IV spikes before earnings? It expects a big move. Why? Options get expensive before big announcements. So after earnings, the stock moves 2%, but your option lost value. Why? Right? You picked the wrong strike. IV crush, volatility collapse after the event. The market is rigged. Who doesn't think that? All right, so let's go ahead and pick B because IV crush. Why? IV crush after earnings, uncertainty is gone. The IV drops, the option loses value even if you guess the right direction. A classic trap. That's why I don't trade earnings. High IV means options are blank, so it's a good time to blank, right? Options are what? Expensive, so it's a good time to sell them. So let's go ahead and put B. Again, noticing a lot of B, bruh. All right, so now let's go over our Greeks, right? So Greeks measures how an option price changes based on the different factors, right? And here's your risk management scoreboard. So Greeks is your option sensitivity dial, right? So we have the strike price, and this the strike price. This is what we're thinking the option is going to be around. We have delta, we have gamma, theta, vega, and rho. Each Greek tells us something different. So delta is the dollar change per, is the change in dollar amount per $1 move in the strike price. So if delta is 0.5 and the option moves 0.5 for every $1 movement, right? Either positive or negative, right? So delta tells you how much the option is going to move for every $1 movement in the stock, right? Delta also tells you the probability of profit, right? So if you have a delta of 0.5, this is also letting us know that, hey, we have a 50% chance of this particular option contract being able to be worth some money. All right, good deal. Gamma is how fast delta changes, right? So this is the acceleration. So if delta is the car, right? Gamma is the acceleration pedal, right? So we want higher gamma, the higher delta changes. And every time delta changes, right, we're making more money, right? So being able to find option contracts that have higher gamma is in essence allowing us to be able to see the delta being able to change, right? Theta is we're losing dollar amount every day because of theta decay. So theta of negative 0.5 equals we're losing $5 per day per contract, right? So theta works against us if we're buying option contracts. Theta works for us if we're selling option contracts, right? Now, we haven't gotten that crazy yet with regards to selling option contracts. Yes, it makes sense to be able to do that, but we haven't done that yet. We normally work with 0 DTE strategies and being able to buy them. Yes, we sell a few, but again, I would recommend that you just watch some of our videos to be able to see that. But let's keep going. Let's stay on topic. So theta is how much we're losing per day. Vega is the change in 1% changes in IV. So Vega of 0.10 is the $10 gain if the IV rises 1%. And then Rho, this is, we barely use Vega and Rho. I say barely, but it's good to know, right? Rho is the dollar change per 1% change in the interest rate. So usually a small impact for short-term options, right? All right, beautiful. Let's go ahead and take our quiz. So option has a delta of 0.5. The SPY goes up $2. What is our option gain, right? How much does your option gain, right? So let's think about this. The option is 0.5. We just learned that for every $1 movement, the option contract is going to move however much the delta is. It's going to move X, right? And X in this example is 0.5, right? So if we're moving $1 bet, that's 50 cents, right? Or $50. If we're moving $2, right, that's $100, right? Or $1, right? So if we, since we broke this down, B. Beautiful. Again, I'm noticing a lot of B's. Why? Delta equals 0.5 times 2. The move equals a $1 gain. Delta tells us how much the option moves for every $1 movement in the stock, right? And every contract equals 100 shares, right? So that's why it's 100. Beautiful. Let's keep going. Theta is negative 0.5. What happens to our option contract overnight? Are we making $5? Bro, I wish. Are we losing $5? Seem more probable. Nothing. Theta only works during market hours. I wish that was the thing, right? Like theta just turns off as soon as the market is off, right? Like it's clocking out. No, so we're going to be losing $5 a day, right? Let's go ahead and put B. Again, I'm noticing a lot of B. Why? Theta is time decay. Negative theta, you lose money every day you're holding the position. So negative $5 times 100, that's just 100 shares. We're losing $5 per day. The clock is always ticking. All right, which Greek measures the sensitivity to changes in IV or volatility, right? Is it delta? And remember what delta measures? Delta measures how much the option contract is going to change when the stock moves up or down $1. Is it theta? Theta measures time decay, right? How much value you were losing for every day we're holding the option contract. Or is it Vega? What does Vega measure again? Oh yeah, Vega measures volatility, right? So for every change in percentage, the option contract is going to move this much in volatility. Let's go ahead and put C. Finally, one of the first C's. Excuse me. Why? Vega measures IV sensitivity. High Vega equals the option price swings more with volatility changes. Important for earnings play. All right. So putting it all together, right? So here's a complete SPY chain from Thinkorswim. So this is how a option chain is going to look, right? So we're going to have our calls to the left, our puts to the right. Sometimes puts are to the right, calls are to the left, but nonetheless, this is how it's going to look, right? So you're going to have your current price that's going to be in the middle, right? So this is the ATM. This is the at the money, right? The higher you go, the further out the money you go. If you're going up, right, these are for calls. And if you're going down, these are for puts, right? Normally, excuse me. But now it's right and left, right? So if we're looking at 683 has negative 999, right? So we probably do not want this contract, right? So here's a cheat sheet, right? On the left side is going to be calls, the bullish bets. Down the center is going to be the strike price. This is going to be our targets. On the right side is going to be puts. These are going to be the bearish bets. The green strikes are going to be in the money, has intrinsic value, right? What is intrinsic value, right? It is the strike price minus the what? All right, let's go back. I just want to make sure. Implied volatility, expiration date, intrinsic value. So intrinsic value is the hopes and dreams, right? This is the actual real profit built into the option right now. So if we exercise the option, this happens instant, right? This is what we'll get. Simple math. So this is the strike price minus the current price, right? For the intrinsic value. All right, beautiful. So let's go down to where we are right now. Excuse me. Bid and ask, this is what you can sell it for and buy it for. The spread is the cost. The delta is how much it moves for every $1 move. The theta is the time decay, and IV is the implied volatility, right? So this is what a real strike price is going to look like. Now let's go ahead and go to the first method. Now the first method that you can use in order to select an option contract, right, now that we've fully gone over it, is using delta, right? So being able to use delta to select an option contract. What is delta? Let's go over it one more time. So delta tells you two things, right? Delta tells us how much the option moves for every $1 movement. So a delta of 0.50, if the option gains 0.50 when the stock moves up $1. And it also roughly tells us the probability of the option expiring in the money, right? So a delta of 0.3 is a 30% chance that we're going to be profitable at expiration. There's a common deltas for our algorithms, right? 0.80 is deep in the money delta. This is basically a stock replacement high win rate, right? These are going to be super expensive for ITM. At the money, this is balanced risk reward. This is for swing trades, right? 0.3, this is slightly out the money, directional bets, good leverage. 0.16, this is one standard deviation away from out of the money. 16% chance premium selling target. And 0.5, these are far out of the money contracts. These are lottery tickets. These are cheap and unlikely, right? So why algos use delta first selection? Instead of guessing on which strikes we're going to pick based on probability, right? Want a run weight of 70%, we're going to select a delta of 0.70. We want high leverage, we're going to select a delta of 0.30, right? We're selling premium, we're going to select a delta of 0.16, one standard deviation for protection. The algo finds the price that matches our target data. So here's an example of what the code looks like for a few of our algorithms, right? When it comes to being able to find delta based, to pick an option contract based off delta. So here's an example of how it looks. So how it works, we loop through all strike prices in the option contract. For each strike price, we get the delta value. We calculate how far is the delta from the target price or the strike price, right? And we keep track of the closest match. And then we return the contract with the smallest difference. And then trading bot, this is how it would look, an example. All right, so let's go ahead and go to a live demo. We're going to be using SPY. SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. It is an ETF. What is an ETF? An ETF is an exchange traded fund, right? So whenever you think of an ETF, I want you to think of a quilt, and each one of the patches within the quilt represents a different company. This particular quilt has 500 different patches within it, right? It does have 0 DTE, meaning that option contracts that expire the same day. So finding contracts by delta target. So deep out in the money, we have a strike of 677, a delta of $1, right? A bid of 0.44, ask of 0.73, 100% in the money, right? And the further out we go, the less in the money we get. But again, the more affordable it gets, right? And then the same delta, but with just different expirations, right? So 0 DTE, these are option contracts that expire the same day. And here's deltas with weeklies, right? So you see the more time we get, the more expensive it gets, right? It goes from barely $1, right, to $94, $151, $185, $199, $219, $255, $270. The more time, the more expensive, right? Key observations is the same 30% probability, but with different strikes. The longer expiration dates equals higher strike prices, the more time you get to get there. The longer expiration dates equals higher premium, right? Because we're paying for the time value. The 0 DTE is the cheapest because it expires today and it has the highest risk. So let's go ahead and answer our quiz, right? So testing our knowledge, we want a 30% chance of profit. Which delta are we going to select? Is it going to be 0.80? Is it going to be 0.30? Or is it going to be 0.05? Well, if you've been following us along, you would know. Just go ahead and put B, right? It is 0.30, right? 30%. So if we take 0.80, 0.80 times 100, that's 80%. 0.05 times 100, that's 5%, right? So it seems like 0.30 times 100 is 30% chance of delta profit, excuse me. Why? Delta equals the probability of expiring in the money. So a delta of 0.30 equals a 30% chance. This is why delta first selection is so powerful, because we pick based off our probability, based off what we want. So why do algos prefer delta selection over picking strikes manually? It's faster to type. That's funny. It adapts to the price, same probability regardless of the strike price. Delta sounds cooler. That is funny. So we're going to go ahead and B. All right. Why SPYs move from 600 to 700? The 30 delta, the strike changes, but your algo still finds the same probability bets automatically. No manual adjustments needed, right? So the next method that we're going to be using is the premium selection method, right? Being able to select option contract based on the underlying cost of it. So let's go ahead and run the code here. So again, method 2 is being able to use the premium. So what is the premium? The premium is the price we pay for the option contract. It is the quoted per share, but you pay in lots of 100. So simple math, if the premium is 250, we're going to multiply that by 100, and we're paying 250 per option contract. If the premium is 50, we're going to multiply that by 100. We're paying $50 per option contract. Now, if the premium is $5, right, we're going to multiply that by 100, and we're paying $500 per option contract. So why is the budget first selection, right? Risk management. I only want to risk $200 on this trade. So I need you to find contracts that are under $200 or $2, right? But just knowing that we're going to multiply that by 100. Small account friendly. We can start with $1,000 can't buy $10 options. $10 options, right? Filter to or for the affordable contracts. And then position sizing. So the $500 budget equals divided by the $250 premium equals 2 contracts. And then a $500 budget divided by the $50 premium equals 10 contracts. So common budget ranges. Less than 50, we're going to be buying lottery tickets, right? So these are option contracts that are a little bit further out of the money, right? So these are 0 DTE scalps, or these are option plays that allows you to be able to get in and out of positions fast. These are high risk, high reward, right? A premium between 0.05 and $2, right? So $50 and $200. These are day trades, quick directional bets. Premium between 200 and 500. These are swing trades, multi-day holds. Premium between 500 and 1,000. These are longer positions, more delta. and premium greater than 1,000. These are deep in the money contracts. These basically you're buying the stock, right? If you're paying that much money for the premium. All right, and then here are, what is liquidity? Liquidity is how easy it is in order to buy and sell without losing money on the trade. Low liquidity equals bad fills, slippage, and we're stuck in their position. So three things to remember when we're checking the bid and ask spread. So the bid is what buyers pay, the ask is what sellers pay, right? Or how I remember it, right? If you wanted to get into the market, or before you go to anybody's house, right? What do you always do? No, some people don't, but before you go to anybody's house, what do? Don't you ask, right? So if we want to get into the market, we have to ask to get into the market, right? So we're going to be paying the ask price, right? And if we want to get out of the market, we're now going to be putting up a bid, right? And we want individuals to be able to buy it from us. So that's going to be the bid price. So a good bid ask spread is 240 divided by 250. We have $2. That is super tight, right? And then we have a bad bid ask spread, right? Now tight and wide, right? Now some would think, hey, tight is bad, wide is good, right? Not in option trading. You want to be able to have a tight bid ask spread, right? Because if you want to get in and out, wide spreads equals you lose money. You lose money the moment we enter the trade, right? So that's why we don't want tight spreads. Volume is the contracts traded today. High volume is 1,000+ contracts actively trading, good fills. Low volumes at anything less than 100 contracts, dead contract, hard to exit. Open interest, or OI, this is the total contracts that is currently being held. So high OI, that is plus over 5,000. This is many traders, liquid market. Low OI is less than 500, few traders, and you're probably going to get stuck in the position. All right, liquidity rule is that the spread, and I want you to remember this, right? Because this is what is going to be based off of method 3, our multi-factor selection when it comes to option contracts. This is actually what we use, right, for all of our algo builds. And I'm also going to show you a back test, very modest one, but still a back test, right, on being able to show you the multi-factor selection when it comes to option rules. All right. Beautiful. So 4 ways to pick, same budget, different goals. So we have the SPY is the S&P 500, top 500 companies within the New York Stock Exchange. And you just told your AI, right, or your algo that you have $200 that you want to be able to budget for it. So this is the best value. We are buying a super out of the money contract, bang for your buck, smart money. Best delta, right, we're buying it for $123. So we went from $2 to $125. Cheapest is going to be the $2, and then the most expensive is a stock replacement, right? You're buying it for $1,000, right? Like you're super in the money, right? So the value score equals the the delta divided by the premium, open parentheses, the higher equals more probability per share. So what this tells you is that the best value is more probability per dollar. Smart shopping, best delta is the highest chance of profit within your budget. The cheapest is the maximum contracts but lowest probability, and the most expensive moves like a stock but also ties up capital because it's super expensive, bruh. All right, what position sizing, what you can buy for 500. You have a budget of 500. SPY is the S&P 500. Contracts equal the budget divided by the premium times 100. So we can buy 2 contracts. So this is what we can afford. So reading this table, the cost in contracts, the premium, this is what you actually pay, times the quantity, right? It equals 25,000 shares. If we're buying 125, 4 contracts, 500, 400 shares, right? 413, we could buy 1, right? And then 100 shares. And if we're at 313, we're going to buy 100 shares equally, all right? So here's how it looked in the actual trading bot, being able to use the premium selection function in order to do this. And here's live liquidity checks for SPY, the S&P 500. Remember, tight is good, wide is bad, right? Bid is what buyers will pay, ask is what sellers want, and then spread is the difference between the ask and the bid. So here's an example of the liquidity checks, right? Live currently for SPY. All right, a contract costs $250, right? How much do you actually pay? Do you pay $2.50? I wish. Do you pay $25 or do you pay $250, right? So it's going to be 250 times 100 or $250. Beautiful. Why? Premium equals premium times 100 equals the actual cost. So 250 times 100 equals $250 per contract. All right, a contract A equals a premium of $100, right? And then a delta of 30% or 30, right? So every $1 movement, this contract is going to go up by $30, right? Or has a 30% chance of being profitable. Or we have contract B, which is $200, but a delta of 40%. Which one has the better value, right? Contract A, because it's 30 per delta per value, right? Or contract B, right? I'm going to say contract A. Are we right? We were correct. Why? Delta equals delta divided by the premium, right? Contract A gives you more probability per dollar spent. Beautiful. All right, so now let's go to our multi-factor selection. Right now with this multi-factor selection, it is going to allow us, this is what we use, right, for all of our algo bots. So I'm super excited for you all to be able to see this. So with the single way to be able to select, right, so give me a delta of 0.30. What happens if the option has wide spreads, right? Bad liquidity. What happens if we have high IV? It's overpriced. What happens if we have low gamma, right? What is gamma? So if delta is the car, right? Gamma is the gas pedal. If we're not hitting the gas pedal, the car is not going anywhere. So it won't move fast enough for 0 DTE options. These are option contracts that expire the same day. So we pick one good thing, but we ignore 5 bad things. The sixth new way is a 6-factor scoring system. So we score every candidate on 6 factors and we pick the highest total. Each factor gets a score between 0 and 1. Each factor has a weighted, right? So in importance, and the final score is the estimate factor score times, sum, that's sigma, sum times factor times weight, right? So the best overall option, not just one per category. All right, 6 factors. So we have gamma. 0 DTE needs fast move, so this is the most important. The distance, this is the closest spot, high gamma zone. The delta, right? Liquidity, premium, and IV. So we take everything that we basically told you, right? For our others, we combined it in order to come up with this 6 factors in order to select option premium. So this is how it works. So factor 1, we're doing the gamma score. So we're finding options that move fast when the stock moves. So here's the formula. Here's the candidates for it. So higher gamma equals higher score equals better for 0 DTE scalping. Scalping is basically telling you that you're going to be in and out of position super quick. Factor 2 is going to be distance score. So the goal, the strike should be 30% from the current price. That's our sweet spot. So an example. So an example at 500, strike of 501, distance is 20%, closer to 30%, higher score. Strike of 510, distance of 2%, far from 0.3%, so low score. So closer to 0.03 distance equals higher score. So the delta score, the goal is to target delta around 0.2, balance leverage plus probability. Closer to 0.2 equals the higher score. 4 is liquidity score. So tighter bid ask equals less money lost on entry, right? So tighter spreads, higher score, better fills. And then factor 6 is going to be IV score. Lower IV equals cheaper premium equals better value. So let's go ahead and see this, how it's done in the code. So this is how it looks in the code. And then here's a live look of it that gives our algo the 5 values, right? And then it'll let us know, ding, 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 ding. Here's your winner, right? A 685, 35, right? Low IV, right? So we have our liquidity, right? We have our delta and the gamma, right? The score of 82.40, it takes everything, aggregates it, and gives you the score. And then this is the top winner. So this is how it looks in the code for our bot, for our 0 DTE scalping bot, right? So here's the actual code. All right, and let's go ahead and answer our questions. In the SKIC scoring factor, which 2 factors have the highest weight, right? Is it the delta and premium? Is it gamma or distance? Or is it liquidity and IV? Oh, it was B. I should have guessed B, but I just wanted to make sure y'all was listening. right? So why? Gamma and distance are the most important factors for 0 DTE. You want high gamma, right? Fast moves and strike distance to the sweet spot where gamma is the highest, right? With the score of 0.85 better than 0.65, right? 0.85 is better delta, 0.85 is better gamma, 0.85 is the overall score of the factors. All right, beautiful. So let's go ahead and run our back test. So what I want to show y'all is a back test that's using the actual 6 methods, and I should have ran this before, but we're going to actually see the back test ran. Oh, if I can get this ran. And this is a back test. So what is a back test? A back test is being able to take your strategy, drop it off in a time machine, and seeing how well it performs in the particular year that we select. So this is a back test that we're going to be running on 2024. This is a back test that uses the EMA Cloud Bounce that we're using let's just review it real quick while it's loading because it's going to take a bit. So the strategy is the EMA Cloud trading strategy for 0 DTE options. The cloud is the zone between the fast EMA and slow EMA. We trade off the bounces from this cloud when the momentum confirms it. So here's the core concept. The spaces between the two EMA acts as dynamic support and resistance level. What is support? Support is the lowest low that the underlying asset can be. Resistance is the highest high the underlying asset can be. In an upward trend, the price bounces back to the cloud and then bounces. And a downward trend, it rallies to the cloud and then rejects it. We use the SMA, or the simple moving average divergence, to filter to confirm the moves, right? So here's our EMA cloud components. Here's our momentum filter. Here's how we get into a call, right? A call because we're bullish on the position. The cloud, the 2 EMAs greater than the 12 EMA, the momentum confirms it. The 12 EMA is greater than the 8 SMA. We're using SMA and EMA, right? And then the cloud width is greater than or equal to 0.02. We enter once the cloud, okay, maybe I can stop. Okay, it's almost there, right? So you're seeing how we enter on both the calls and the puts, right? It's here, and here's a visual representation of it. The price, okay, I can stop talking. The back test is running. So we're going to be running our back test on this EMA cross strategy. This is we're trading it on QQQ. QQQ is the top 100 tech companies within the NASDAQ. Now, the biggest difference between QQQ and SPY is that QQQ is tech heavy, right? Whereas SPY is going to be a bit more diverse because it has 500 different companies within it. So our back test is running. As you can see, it runs a lot more faster than it loads. All of our strategies start at $100. So we load the back test with $100 and we want to see how well it performs in that current year. So it's in 2024. It had 136 trades and went from $100 to $3,549.46. So our Sharpe ratio is 0.32. What this measures is the return per the risk, right? So our 0.32 is a bit poor, but I want you to think about the return from 100 to 3,500, right? So there's a bit of a trade-off here. Our Sharpe ratio is 0.75. What it measures like the Sharpe ratio, but only penalizes for downside volatility. The Calamar ratio, what this measures is the annualized return divided by the maximum drawdown, right? The system quality score is 3.7. If we look at the score, we're under the excellent, right? Our maximum drawdown is 50. So at one point in time, the strategy was at $50 and then it was able to rally to 3,500. That's not that bad. Our recovery score is 68.51. What this measures is the total return divided by the maximum drawdown. So our win rate is 66%. So 2 out of every 3 trades we are winning. Our profit factor is 2.23. What this means is that for every $1 that we lost, we are making $2.23 back. Now, this is your boy Creative. We will be back at it again with another episode. Please don't forget to like and subscribe. And we're going to be continuing our KreativeU series. I really do appreciate y'all for stopping by. If you do have any questions, comments, or concerns, please feel free to leave them in the comments as I will answer them. Thank you again. Again, don't forget to like and subscribe.